We all know a global pandemic made 2020 a particularly difficult year, both financially and emotionally for many. Even so, the S&P 500 price index gained 16% in 2020, which is a surprising performance, often credited to the speedy development of vaccines and massive economic stimulus, which was provided by the Federal Reserve and Congress. So while the S&P 500 is generally considered representative of the US stock market, this recovery was actually powered by technology giants that thrived on the stay-at-home economy. If you look back, in August 9th, 2020, the big six tech companies, Apple, Facebook, Amazon, Netflix, and Microsoft, and Alphabet as well, which is, by the way, Google's parent, represented more than 1/4 of the market value of the S&P 500, which gave them outsized effect on index performance. Of course, there is no way to know what the defining moment of 2021 will be, but you can count on market swings to challenge your patience as an investor. Political uncertainty, international conflicts, interest rate decisions, and economic shifts here and abroad can actually spur volatility in the financial market. And it's generally a case of when and not if it happens. So it's only natural to be concerned when the market drops. But expecting volatility and having a sound financial strategy in place may be the best defense you could have when events roll the markets. This might also help prevent you from making emotion-based investment decisions. You see, your plans for the future shouldn't have to depend on daily fluctuations in the stock market. Basically, gains and losses are part of investing. But by using deliberate, time-tested approaches, you may be able to pursue your goals without feeling as though you need to consistently adjust your portfolio to react to today's news. You see, the performance of an unmanaged index is not indicative of the performance of any specific investment. And as an individual, you cannot invest directly in an index. Past performance, of course, is no guarantee of any future results, and actual results may vary. So let's consider how events have influenced the performance of the Dow Jones Industrial Average, which basically tracks the prices of 30 of the largest US companies from 2007 through 2020. The graph you see up there starts just before the financial crisis that led to the Great Recession. Dow stocks fell more than 50% between October 2007 and March 2009. Yet recovered much of their losses during the last 3 quarters of 2009. So stocks continue to climb over the next decade, but not without enduring bouts of volatility. And the Dow last crossed the 10,000 mark in August 2010 and surpassed 20,000 in January 2017. So in 2017, the Dow posted 70 record closings. It's a feat that also set a record and approached the 25,000 mark. The anticipation of tax cuts overcame 3 interest rate hikes by the Federal Reserve, and that's in 2018. And the Dow crossed 26,000 for the first time, but fell sharply in the fourth quarter, and it closed out the year just above 23,000. 4 interest rate hikes, political strife, and a trade dispute with China made it the worst year for the stocks since the financial crisis. Now let's go 2019. The Dow dropped more than 6% in the month of May, mostly due to escalating trade tensions. And in August 14 of that year, the Dow plunged 3% when a yield curve inversion triggered recession worries. After that, the Dow recovered quickly and kept climbing, sending the year above 28,000. Now let's go to 2020, where the threat of COVID-19 and a sudden economic recession sent financial markets into a tailspin, and the Dow dropped below 19,000 on March 18th, and then bounced back quickly to end the year at an all-time high above 30,000. As you can see, the market swing that accompanied the past 2 recessions, which is 2008 to 2009 and 2020, would demonstrate why overreacting in fear can result in even greater losses. Investors who panicked and sold stocks when prices were falling may not have been positioned to participate fully in the market recovery. So realizing that the markets are historically cyclical may help you stay calm in the face of market volatility. Do you know the difference between a market pullback, a market correction, a bear market, and a bull market? A pullback is typically defined as a 5% to 10% dip in market index, like the Dow Jones or the S&P 500 index from a recent high. When the market loses 10% to 20% below its 52-week high, it's considered to be market correction. And a bear market is typically defined as a decline of 20% or more from the most recent high, and a bull market is an increase of 20% or more from a bear market low. Beginning on February 19, 2020, worries about the spread of COVID-19 sent U.S. stocks into a bear market for the first time in nearly 11 years, and the S&P 500 index dropped nearly 34% in February and March before it rebounded to a new high by the end of the year. A simple explanation for the disconnect between the buoyant stock prices and the economy that continue to struggle is that the stock market is forward-looking. See, investors believed that the pandemic would be controlled in the not-too-distant future and business activity would return to normal. And that's what happened here. Remarkably, a new bull market began on March 23rd, 2020, when the index closed at its official low point. The 2020 bear market was the shortest in record, lasting just 33 days. There have been 11 bear markets since 1950. On average, bull markets lasted longer by 1955 days than bear markets, which are 395 days over this period. And the average bull market advance, 172%, was greater than the average bear market decline, which is 34.2%. The takeaway is that neither the ups or the downs last forever, even if they feel as though they will. So when developing your financial strategy, it is important to consider how overall economic conditions might affect your investment portfolio now and in the future. You should position yourself financially for a range of possibilities, taking into account the factors that may influence the economy and financial markets, many of which are listed here. On June 8th, 2020, the National Bureau of Economic Research, which has the official responsibility of determining U.S. business cycles, announced that February 2020 marked the beginning of a recession. By the way, this is not a surprise considering the severe disruption in business activity due to COVID-19 and the immediate spike in unemployment. One common definition of a recession is 2 more quarters of negative growth gross domestic product, which is the GDP. The value of all goods and services produced across the economy contracted at an annual rate of 5% in the first quarter of 2020. And that's before shrinking by a historic 31.4% in the second quarter. Now, GDP bounced back 33.4% in the third quarter and expanded 4.1% in the fourth quarter. But overall, the U.S. economy shrunk 3.5% in 2020 from 2019 annual level. You see, about 22 million jobs were lost in the first month of the pandemic in April 2020. The unemployment rate spiked to 14.7%. That's the highest official rate on record. Just 2 months earlier, it was 3.5%, a 50-year low. By December 2020, the headline unemployment rate had improved to 6.7%, but more than 9 million jobs had yet to be recovered. You see, the economic turmoil caused by COVID-19 prompted the Federal Reserve to slash the federal funds rate from a range of 1.5% to 1.75% to a range of 0 to 0.25%. That's in March 2020, where it stayed like that through December. And the Fed also implemented a new policy of virtually unlimited bond buying and launched an emergency facilities so that would help stabilize the financial markets. The federal government also passed one stimulus package in March 2020, another in December, which together, I think they provided more than $3 trillion in economic relief for hard-hit households and businesses, among other things. Now, on a positive note, the housing market got unexpected boost from the COVID-19 pandemic because buyers took advantage of low mortgage rates and the shift in remote work. So more spacious homes in suburbs or away from major cities offered less expensive and or more comfortable places to ride out the pandemic. You see, the national median price of an existing home ended 2020 at $340,000, which is an increase of 13.4% over previous December. Now, I'm sure many of you still have lingering questions. So remember, if you're wondering something, it's more than likely that someone else is too. So let me know how we can help and send in your questions. And by the way, if you want more information, we have a webinar on tax planning and retirement. And the link, by the way, is in the description. Many aspects of retirement will affect your tax bill in ways different than your working years. Our tax system is confusing and it treats various income types differently and contains hidden taxes and penalties. This webinar will discuss key tax issues you will need to anticipate. See you in the next video.